Hello, guys. Good evening. This is your boy Ken Akure, and I'm here. I'm here excited because the crypto market has fulfilled the prophecy that I've been prophesying as a prophet for since May. Yeah, since May, I've been saying this market is bullish. This market is going to will go up. This is not a bear market. Even when we went as low as 30,000, I did several articles saying that we're going to be in the range between 30,000 and 40,000 plus or minus 2,000. We're going to be there for several weeks. I actually said 8 weeks, 2 to 8 weeks. Then we'll see push to the upside. And I gave reasons why I came up with that conclusion from data based on Bitcoin's previous performances. I was able to come up with that data, and a lot of people panicked and sold at a loss. You know why? Because there were other people saying that, oh, this market is going to zero, it's going to 5,000, it's going to that. But we're here today and the market is making new highs. Now, for those who trade futures, for the past few weeks, if you're a trend trader, then it's always very difficult trading in a range because most of your strategies require you to hold the trade for a while. So trading in a range has actually not been pretty smooth for a lot of people who like to get into position and hold for days or for weeks. But now the market has given us a serious bullish confirmation. And this is a kind of confirmation or kind of market situation that trend traders like to follow. So I'm going to be talking about a trend following strategy in this class. So I'm going to run through how to do the setup, what the rules are, and yes, and everything that you need to successfully use a strategy on any time frame that you want to use it on. Okay, so I'm going to strip all these indicators off. Oh no, I'm going to put them off. So I want to remove that, then I want to remove this. Okay, so let's put our indicators, our trend indicators, our trend-based indicators. So you come to the indicator tab, click on it. Then the first one you want to search for, you search for 20, 20-50. Oh no, not dash, 50-100-200. So you see several of them. There's the one for EMA. Then there's one for EMA. There's one for another EMA. I'm looking for the one that is daily moving averages. Okay, I think it's this one. So this is the one. So I click on this. Yeah, so that is the one. That is the one. Then this is actually all I need. And the good thing about TradingView is that you can always hide the indicators when you don't want to see them, then put them back on. So this consists of the 20 simple moving average, the 50 simple moving average, the 100 simple moving average, and the 200 simple moving averages. And why are these moving averages powerful? They are powerful because of their moving averages that a lot of traders in the market use. So they act as dynamic support and resistance in the trending market. Sometimes you are expecting market. Okay, let me give a good example of what happened here. See, this is a 100 moving average here, acting as a dynamic resistance. Sorry, a dynamic support rather. Now sometimes you expect market to get to, let's say sometimes market is retracing. Retracing means this market went up. You're expecting to get to a support level, which is somewhere here. Okay, let me use a better line for that. Okay, you're expecting market to get to, this is a support level. Let's say this is a support level. Okay, let me change this to tick. let's make it okay, let's make it white. Okay, so this is your support level. You're expecting market to drop down to this level. Then maybe you're expecting a reaction on this level, but then it doesn't, and you're wondering why. And the reason could be that there's actually a moving average acting as a support, a dynamic support. So if you don't trade with moving averages, like if you have all these moving averages not closed, then you'll still be expecting this market to come down to this area, this zone. So if it doesn't, you'll be wondering why it did not. And it is because something else was acting as a dynamic support and resistance. And if you look throughout the chart, see here too, see here, sometimes those dynamic support and resistance levels coincide with your normal support and resistance levels. Like here, here it coincides with this one. Many times it coincides. Many times it does coincide. Like here too, here now, it coincides with this level here. So you want to know that. So that's why we use moving averages. And moving averages work powerfully well when the market is strongly trending. If it's in a ranging market, they can actually be very frustrating if you're in a ranging market. But in a strongly trending market, then they are beautiful. They are awesome to use. Okay, so now you've had that on your chart. You could also maybe add, let's keep this simple. So let me delete this. You could add maybe an oscillator. Let's add the RSI, Relative Strength Index. So you type for RSI, Relative Strength Index, a simple one. You don't need to do any modification at all. And how the moving average, RSI works is that when your market is oversold, then you get buying opportunities. When it's overbought, okay. Before I go on, let me explain that the RSI is a lot of people mistake it for it just being an oscillator, but sometimes it can also tell you the direction of the trend. So let's do this. Okay, so this is your RSI. You have the 50 level. The 50 level is like your pullback level. Then your 70 is your overbought. Sorry, yeah, overbought. Then your 30 is your oversold region. Then what a lot of people don't know is that your RSI also serves as a trend indicator sometimes. If you find out that your RSI is mostly above the 50 line, then it's actually trending up. If it's mostly above the 50, it's trending up, But that's by the way. So how do you now use this system? Okay, so you have your moving averages, then you have your RSI. But before we go into that, you hide this indicator. Then you want to draw your zones. You want to make sure your zones are clearly marked out. And if you guys notice, I don't use so much of trend lines. I use trend lines, but not so much because sometimes I feel, unlike support and resistance lines, you can actually tell exactly where a horizontal level is broken and than where a diagonal level is broken. So sometimes I really don't use trend lines. Why? I replace my trend lines with moving averages, and sometimes I'm cool with that. So if we're to use trend lines now, this will have been where to enter this market on this candle. But if I'm using moving averages, then I would have entered on this somewhere here instead of waiting for this move if I was using moving averages. So that's why I really don't use trend lines. And sometimes too, trend lines can also be misleading. For example, see here, if I pick here and I'm supposed to drag here, So at the break of this trend line, I'm supposed to sell. Yeah, of course, it sold, came down, you know, of course. So, okay, so it played out well in this situation. Anyway, my point is that nothing works 100% in trading. So you need to know the limitation of everything you use, even your horizontal levels. You need to know when their limitation comes in. And that's why you combine some other things to help you make an accurate decision. So let me delete these trend lines. Okay. So in the videos, if you've gone through the videos, okay, let me actually delete the entire thing. So if you've gone through the video, I spoke about drawing your key levels and your minor levels. So when you come to the chart, if you trade on the H4, or if you trade on the daily, so if you trade on H4, you want to draw your key levels on the daily chart, so you can as well come to the daily chart, then draw your key levels. This is a key level here. And drawing key levels, you can use two ways. You can either make this horizontal, you can use the line chart, or you can use the line chart, or you can use the candlestick chart. Any one you use is fine. Let's use the line chart and see how this turns out. So when you're using the line chart, you're trying to pick a place that acted as resistance below and somewhere on top. Here is not so clear. So let's just do this first. We'll see more clearer areas when we go to H4. So then you want to pick the most recent areas. The most recent areas usually have more significance than an area that has been happened a long time ago. So focus on recency. Recency, so we can represent this with, let's make this, since it's a daily, let's represent this with this line and make it very thick to signify that this is what's happening. Anyway, let's make that red. Let's make the zones. Let's give them a color red. Sorry, I use this. So these are your daily levels. There's another one somewhere here. Let's clone this guy. There's another level somewhere here. Then of course, there's a level here. There's a level here. Okay, so this is enough. When price breaks above, then we'll draw the level up there. So far, all this that we have is more than enough. In fact, maybe even too much. Sometimes it's even just good to just focus on, delete this other one and focus on where price is right now. There's no point analyzing where price is not. So stick to where price is. The step above, the step here, and the step below, maybe a step above, then that's all. Those are the areas where price is. So if price decides to break below, and then you start adding other levels, so this is fine enough. Then we'll go to H4. Let's reset this. H4. Okay, let me use candles. Okay, for your H4 now, you now want to use maybe another color of lines. So let's make this white. This is an area of resistance. Let's make it. Let's make it white. There's a zone somewhere here, somewhere here. Okay. There's another one here, but that is okay. When price breaks this level, then we start thinking of these other levels. So for here now, we're okay. So here the price is now, we're looking at a breakout. Is that we have a breakout, or we have a double top and price comes back here and maybe decides to range before pushing higher, or ranges then breaks down. If you're trading futures, you have to be very open-minded. You don't say that, okay, this market is only an uptrend, so the possibilities is only up, 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 up. No, you don't do that. You just have a mechanical strategy that you follow, irrespective of what you think is happening. Of course, you can always change your mind, but you're changing your mind based now on what you're seeing, based on your trading strategy. Okay, so now we've marked out our zones. We've identified the key areas, the minor areas. Now, we can now unveil our indicators. Then the next thing is you can now decide to choose what time frame you want. Okay, first, you would have chosen what time frame you're trading on. So for the sake of this class, let's say we're trading on H1. So this is a H1 chart. This is what it looks like. So now we're going to unveil, okay, if you're trading on H1, it means we need to add some more zones. So we need to add a zone here. We need to add an area here, yeah, because can you see why it's always good to wait for a breakout? This is a false breakout. Now this guy is going to come down, then maybe try pushing up again tomorrow. So, okay. We have this now. We've drawn out the zones. Don't try having too many areas to look at. It will only get you confused. So now we have our chart set up. So now we're going to have extra confirmations. Now, with this alone, you can make trades, you can make entries. Do you understand? But you want to have an extra guide. That's where your indicators come in. So your indicators, like the name implies, indicate. They are supposed to indicate something. They are not supposed to tell you what to do. They are only supposed to point out something to you that you will not be able to see if that indicator is not there. So it's an indicator. So, but your normal price, you can already see that with your naked eyes. Oh, you can see this. You can see this with your eyes. You don't need an indicator to show you where price is. Do you understand? But you need it to confirm other things to you. So when you bring out these moving averages, they can now, overall, this market is trending. Why? Whenever price, which is this candles, is above your 100 and your 200 moving averages, then the market is trending up strongly. So what you want to focus on in those situations is to look for buying opportunities. So you're waiting for the pullbacks. Of course, you can counter trend and sell. Sometimes, yeah, if you're a day trader, sometimes you get bored and you want to just counter trend and sell. You want to sell the pullbacks. As well as you want to sell the corrective wave as well as the impulse waves. Yeah, you want to do that. Why? Because especially if you're trading only a few pairs, you want to be able to do that to maximize your profit potential. But to keep it easy, it's always better to focus on the direction of the overall trend. Those are the less risky trades. When you focus on the overall direction of the trend. Okay, now, so what are the rules now? The rules are simple. Now, you must live by rules. If you don't follow your trade, you cannot depend on your brain enough, to be a good trader. Now, in the video, I also spoke about the different dimensions of trading, where you can be a mechanical trader, a discretionary or subjective trader, or an intuitive trader. Now, the safest place to be, discretionary is wonderful, it's perfect. Okay, a mechanical trader is when you have fixed rules, maybe one rule or two strategies. You pick one strategy, you have the rules for that strategy, and that's all you follow. Day and night, that's the only thing you follow. That's mechanical. You're trading mechanically. You are not thinking. You are just asking a series of questions. Is this here? Oh, if it's here, then we'll do this. Is it there? Oh, it's not there, then we don't take a trade. That's mechanical. In discretionary or subjective, You are putting together everything that you know, and using it to move in and out of the market. You're flowing with the market in and out based on your discretion. So even though the overall trend is uptrend, you can decide to short. You can decide to do counter trend. Here now, you can decide to start shorting this market as a counter trend because you're expecting that it to come here, then bounce. That's discretionary. But if it's mechanical, you are only in an uptrend, you're only focusing on buys. You're only focusing on buys. Why? Because that's what your strategy demands, and you don't want to reason it out or argue about it. Do you understand? Then discretionary, you can combine everything you know about the markets, market structure, Elliott wave, beat the market maker, point and line, divergence, everything you know, Fibonacci retracement, Elliott wave, everything you know about the market, you formulate it, and you are just moving from one strategy to another strategy based on all the things you've learned that in your head. That is good. Then there is the intuitive stage of trading where the market whispers to you. It's like the market tells you what it's going to do next. It's like instinct. You might even be trading sleeping at night, and a voice tells you once you wake up, buy Ethereum. A voice just tells you, oh, get out of the market now. And you get out, and as you get out, you see a dump or something. So you are not using, even though your strategy says buy, the intuitive voice might tell you sell. And maybe once you sell, one news comes from somewhere that they say, oh, Binance has been hacked. Or the US government just said everybody holding crypto should go to jail. And the market starts dumping. That is intuitive. There are things that your strategy cannot tell you. It's like spiritual. Yeah, I like to call it spiritual trading. All those ones are beautiful. But the truth is, all the people in history that have depended on intuitive, subjective, and discretionary trading, most of them didn't end up good. They made a lot of money, then in the end, they lost a lot of money. Or they made a lot of money, then at the end of their career, they really maybe just quitted trading altogether. But the people who have survived day in and day out are those who trade mechanically. Mechanically is the most basic. It seems as if it makes trading boring. It makes trading uninteresting because you're just following rules like a machine. So there's no excitement. Do you understand? When you lose, you cannot lose big. When you make profit, you cannot make big profits. Do you understand? Because you're just following the strategy as it comes. And now I want to tell you that boring strategy, that boring method of trading is the best. Because when it comes to a game that involves speculation, you cannot depend on your brain alone to tell you what to do. Your brain will fail you. Why? Because your brain will try to protect you from making losses. And in the process of wanting to reduce losses, you end up making more losses. Your brain will protect you from like now, the market is going against you. Instead of you to get out quickly and cut your profit, your brain might tell you to stay in the market and to go back up. Your brain might tell you not to use stop loss. Even if the market goes down, it will come up. Then you market ends up keep going against you. But if it's mechanical, all the rules are there. You must follow them. Whether you like the rules or you don't like the rules, you have to follow them. And that is what I want to introduce you guys to mechanically. If you trade mechanically, you remove emotions, you remove all those things because you are following only one thing, So let's follow this one thing. So what are the rules? So let's type in the rules for this mechanical trading. So this is a trend following strategy. This is a trend following strategy. So let me bring out my notes. What's it called? So let me bring out somewhere here. So let's call it the tools, or let's call it the setup. So the things you need for this strategy to be complete: number one, you need support and resistance levels. You need to draw out your support and resistance levels. That's number one. Number two, moving averages. And you have, actually the moving averages you really need are 50, 100, and 200. But then this indicator, it has to take all of them. You can't just choose which one. And the trading view I'm using is a free one. So I can only add 3 indicators, but then by adding all these 3 together, they see it as one indicator. So that's okay. So you have moving averages. So let's say 50, 100, and 200. So those are the moving averages. Then you can either use simple moving averages or exponential moving averages. I prefer to use simple. There's a difference between the two, but we can't discuss that in this class. I use simple. Now, this is the setup. First thing, okay, then of course, number 3. Your support and resistance levels tell you of market structure. They tell you about the structure of the market, the overall direction and trend of the market. That's what your moving averages tell you. Market structure. Then number 2, simple moving averages tells you about trend, the trend of the market. In what direction is it trending? Then number 3, your RSI, relative strength index, tells you about pullbacks, overbought, and oversold. It actually should be overbought, oversold, overbought, oversold, because the pullback level is in the middle. Pullback level is your 50 line. So now this is what this setup requires. So you have that now, and you know what everything is used for. Your support and resistance level tells you about the market structure, and you want to be trading in line with the market structure. You need to know when that trend has changed, or if that structure is broken. Then number 2, your simple moving averages tells you about the direction of the trend. And these are the simple moving averages. You have 50, 100, 200. And I said that these moving averages are powerful because that's what a lot of people look at, in the market. So it becomes like a self-fulfilling prophecy. So you have this now. This is a setup. So let me copy this and paste it somewhere. I'll post it on the group later. So let me open my Google Keep. Let me paste it in my Google Keep so I can send it to you guys later. So setup. So now I have the setup. Let's go back. Now we need to, okay, let me delete this now. Okay, I need to clear. Okay, so let's do another one and insert again. This time around, now we're looking at the rules. So there are only 2 things you can do in the market. You can either buy or sell. So we need to create buy and sell rules. So text. So for buy, I'm going to send a picture of, I actually have a buy and sell rule. Where is it? I have one somewhere on I have a board. I have a board that's somewhere over there. So the rules are on the board. So I check them when I want to take a trade. And most times when I do that, I trade very well. Like I'm more conscious of my game. But sometimes I'm a human being too. Like I get carried away, I get distracted. I see an opportunity, I want to jump on it, and I want to use something I've known about the market before, and most times it backfires. So the rules are there on the board. So I try to go over them as much as I can. That keeps me coordinated and in balance. Don't assume that you know the rules on your head. Have them on paper. This is serious business, and check them. Check them. You want to control your emotions. You want to control when your heart is beating fast. You want to control when you are fearful. You want to control when you're being greedy. And these are the rules that will help you. Do you understand? You can't depend on your willpower or your intelligence alone. You need to follow these rules. Why? Because you are putting real money on the line, and you don't want to go and work, labor, get money, then put it into your trading account and make losses. It doesn't make sense. Trading is very similar to gambling. And the only way to trade in this environment and not be a gambler is to have a set of rules, that hold you so that you don't veer off too far, from your safe zone. There's a safe zone, there's an unsafe zone. If you want to swim in an ocean, you don't go swimming in the middle of the ocean. You swim at the banks. You swim at the river banks. You swim at the banks. You don't want to go and be swimming with sharks. They'll eat you. And if you don't have rules, you are putting yourself into the water. You want to go and swim with sharks and whales. They'll swallow you up. So your rules are the only thing that can guide you. This is very serious. That's why I'm emphasizing. If you cannot come up with rules, it doesn't matter what you've learned about trading. It will backfire. You will lose money. You'll be frustrated in this game. I don't want to raise frustrated people. So buy rules. So let's call them buy rules. Then the other one will have sell rules. So this is for futures, don't get it wrong. So the buy rules will have number one, to buy, you are asking questions now. So, okay, excuse me, guys. Just a moment. I want to enter a trade. I want to do a logical. Okay. Okay, I'm back here. I'm actually counter trending. So I'm shorting this market. Let me see if I can collect small profit to this level, then I get out before I go to bed. Okay, so let's start all over again about the rules. Sorry, I got distracted. Okay, so where's my distance again? Okay, somebody said they want to use the naked trading strategy. Okay, like I said before, after marking these zones now, you can decide to hide your indicator. Most of the charts that I send to the group, I usually don't send it with all the indicators. Now I don't, meaning I can trade with the naked chart. Do you understand? But I don't. I want to keep my life simple. It is not by trading naked. I see some people who are priding themselves on the internet that they trade without any indicator. All those pride is rubbish. What you want to do is to trade and make money. Whether you use 1 million indicators or you don't use indicators, if you are making money, fine. Don't give yourself a headache and say, oh, I must trade without indicators. I've been trading for how many years now? Since, let's say actively since 2019. I can tell you that your trading strategy is useless. Trading strategy does not mean anything. You can have the best trading strategy and still lose. It's not the strategy, it's in your mind. Everything about trading is your mind. 80% or 90% is your mind. So if your mind is not right, if you train 100 people, teach them the same strategy, give them the same account size, 80 of them will still lose. Only 20 will succeed. The same strategy, the same mentor, the same thing. So it's not strategy. It's about the hunger to learn and succeed, ability to follow rules, and the state of the mind. I've read a lot of book about trading. There's a study that was done where they picked 100 different people in Philippines. I still have that report. Taught them the same trading strategy, gave them the same account balance, told them to go and trade, and they checked them after 3 months. After 3 months, their results were very different. And you're like, is it the same mentor that trained all of you? It's the same mentor. The people that did well did very well. So it wasn't a function of maybe just the mentor. It's a function of the mindset they had and how they perceive the market. And it's only you that can build your mindset for yourself. I can tell you what to do. I can tell you how to approach it. But if you don't practice it or form that mindset, you will not have the results. And that's why trading is hard. Nobody can do that other aspect for you. I can teach you technical analysis, but I cannot teach you how to force yourself to follow the rules. You have to do it by yourself. Do you understand? So that's why it's a little hard, because they don't sell discipline in the market. You understand? I wish I was shorting this market, but let it go. I entered a small short here on my other account. Yeah. Okay, now the rules. Buy rules. Sorry, this class is taking so long. I've done so much talking. Sorry. So buy rules number one. Number one for buy is so you're asking the question, is price at an area of support? So you now check, is it a key support or a minor support? So that's the first question. Is price as an area of support? Is price as an area of support? That's number one. You're asking the question. So you look at the chart. Here now, price is at resistance. It's not at support. So you shouldn't be buying here. Why? Price is at resistance. So even though it's an uptrend, you shouldn't be buying there. Then number two, is price above your market, above your, let's call it market baseline. So your market baseline, the main baselines are your 50, your 100, and your 200 MA. So whenever price is above all these baseline, then you are strongly bullish. If price is above 100 and 200, you're strongly, if price is above 100, then you are maybe a little, okay. Now this is the extreme. If price is above 100, okay, let's put on the indicators. Okay, let's finish the rules. Then we'll put on the indicators so that this thing remains. Then number three. What's number three? Number three is your RSI. Is your RSI overbought? No, oversold, because this is for buy. So is it oversold or at the pullback So oversold is, let's say 30. Oversold is around 30. Then pullback level is around 50. Around 50, between 40 and 60 is your pullback level for your RSI. These are the rules. Then number four, for those who trade naked charts, then you have candlestick trigger. So that price is at a level doesn't mean you just enter. You wait for a trigger. And for your buying trigger, the candlesticks you look for is, let's say number one, you look for hammer. You look for bullish engulfing. You look for bullish engulfing, you look for morning star pattern, you look for tweezer bottoms. Tweezer bottoms. So those are the 4 candlesticks that I look at for. Hammer, bullish, okay, sometimes to a bullish Arami. I'll give an example. Sometimes you look for a bullish alarm. Now, all these candles are even on the chart. As I'm talking to you now, I can see some of them. So there's another one, but let's stick to this. Then you could add chart patterns too as an extra confirmation, but let's stick to this. Then for your sell rules, you're going to reverse these rules now. So for sell rules, you're doing the opposite of this. Sell rules. So now for each of these trades, you need to have at least 3/4 before you can take any of these trades. You must have 3/4, meaning your answer to this question has to be 3/4. You know, if you have 2/4, no trade. 1/4, no trade. 4/4, excellent. Do you understand? But it must be 3/4. Then the one that must be compulsory is this number 1. Number 1 has to be there. It's priced as an area of support. It has to be there. Why? You're trading based off of market structure. Every other thing is Jara. Those who trade naked chart, that's what they focus on. Key levels. You know, so sell rules, you're looking at similar things. So number 1 is okay, so these sell rules, now I'm going to leave you guys to do these sell rules. So just do the opposite of everything you have here, you know. But anyway, let me not assume you guys will do. Let me give everything here. So it's priced at an area of resistance. That's number 1. It's priced at an area of resistance. You want to know, you are asking. Right now, price is an area of resistance, but these other rules are not confirmed, so I shouldn't sell. Do you understand? If I'm selling, then I'm using another strategy. Do you understand? But what you want to do is you want to stick to one strategy and be very comfortable with it. If you are using another strategy, you know that, Ken, you're mixing up strategies. You know it in your head. You know it, that you're mixing up strategies. And if a loss happens, you know why the loss happened, because you're mixing up strategies. So, then, okay, number 3 is price below your market baseline. Is price below and your market baseline, we already discussed that they are the 50, 100, and 200. And if price is above all 3 of them, then the market is strongly trending. If price is above just 100 and 200, then your market is trending, but just trending, not strongly trending. If price is below these 2, but above this one, then your market is weakly trending. It's not strong. So you have strong, normal trend, then weak trend. The trend is weakening. Do you understand? So the same thing to do for this. And what you want to do is you want to stick to one time frame if you're doing this. Meaning if you're trading on H4, stick to H4. Follow these rules on H4. If you're trading on H1, follow these rules on H1. You know, don't be flipping between H1 and H4. Sometimes you might just get yourself confused. You know, so if you're going to follow these rules, pick one time frame and stick to it. The number 3 is your okay, here now is your RSI oversold. So here now you're asking, is your RSI overbought? You know, so you follow the same rules that we have here. 30, meaning is your RSI around 30? So is it around 70? So you have 70 or at the pullback level, which is 50. So you're asking these questions. Then the candlesticks that will tell you, oh, this everything now is set. Now this is the trigger to enter. Number one will be the opposite of what you have here. So the opposite of hammer is, I think it's shooting star. So you have candlestick, trigger. Trigger is when you put the gun. You've aimed, you've targeted, now you want to pull the trigger and enter the trade. So you have candlestick trigger. So you have to wait for these candlesticks to form. When the candlesticks appear, you have more confidence that, oh, you are not the only one looking at that level. Other people want to join you to buy from this level. So you have shooting star. You can take all these names of candlesticks, then go and look at them on the internet. You see what they look like. You know, then you have bearish engulfing. Morning star changes to evening star. There are many candlesticks pattern. You don't want to just confuse yourself with too many of them. Then tweezer bottom, we have tweezer top. Okay, now these rules you must have 3/4 before you take a trade. Now let's look at scenarios. I'm going to paste these rules too. So you copy this rule, you write it down on paper and put it beside where you're trading. You know, so okay, so back to the chart. Okay, so these are, you have your rules now. So when you want to trade, you have your rules, you unveil your indicators. So right now, everything here is bullish. So on this pullback here, this would have been a perfect time to sell, sorry, to buy. Why? You ask yourself, you go over these questions. You have drawn out your support and resistance levels. You've marked them out, meaning you've done your setup, you've unveiled your indicators. Now you're going through your confirmation checklist. So you take your pen and paper, There's my paper. Sorry, guys. Okay, so you have your pen and paper, then you write out the rules you want to follow. Like this is serious business. You write the time of the day is, you write the date. Today is 09/08/2021. You know, and you enter the name of the pair. This is Ethereum. You're analyzing Ethereum. You're about to take Ethereum. So you're going over the confirmation checklist. So the first question you ask is priced as an area of support. You look at the chart. Is there support here? Don't try and form support in your head. That's why you must have drawn these levels first before you start asking those questions. If yes, you answer. Is price at an area of support? Yes, the answer is yes. Number two, is price above your market baseline? Now, in this situation, ignore the green line, focus on the yellow and this other one. The yellow one is your 50 simple moving average. This orange one is your 100. Then the red one is your 200. So you want to focus on these three. So anytime price is on the yellow one or the orange one or the red one, in an uptrend, if it tells you that this uptrend is strong, market is moving uptrend. So when you want to be buying the pullbacks. When market comes to an area of support, in an uptrend, you buy. When it comes to an, see here, it comes to an area of support, you buy. Comes to an area of support, you buy. So you're only buying the pullbacks, less stress. So the counter trend, which is the corrective waves, you are avoiding them. You're not trying to sell. You're only trading in one direction. You know, that's why when they say the trend is your friend, this is what they're saying. So the reason for having this checklist is to be sure that you're following the fact that the trend is your friend. So number 2 is price above your market baseline. In this situation, price was below your 50, but above your 100 and above your 200. So the answer is yes. The answer is yes. Then number 3 is your RSI oversold or at the pullback level. So here, your RSI is oversold, is in the oversold territory. The RSI is oversold, so this market might be tired of going down. So RSI is oversold, yes. Sometimes RSI is at the pullback, like here now, for instance. Here now, RSI is at the pullback. It didn't get to oversold, meaning market went up, then got here. So in this situation here, RSI is at pullback. So you still answer yes if it's here, because those are the 2 questions. You want to avoid buying when RSI is fully here. It doesn't mean the only time you buy when RSI is fully even above this place is when there's a clear breakout. When there's a breakout, then you buy. So that's why I say your answer must be 3/4. So in that situation, your this thing will now be 3/4. Why? Because your RSI is not at the perfect place where you want it to be, but then you still have to take the trade. Why? Because there's a breakout in the direction of the trend. Okay, so but in this case now you can see that market tried to break out, but it didn't break out. Instead, it did a false breakout. It did a false breakout. So if you are FOMOing, you'd have jumped into this market here and now you'll be trapped. You don't know whether to stay in or to get out. But if you realize that, oh, I was FOMOing, I jumped in. Once you realize you made a mistake and you FOMO, get out. Don't train yourself to be a bad boy, a bad child. Once you're violating the rules, get out. Tell yourself, I violated this rule. I've made a small loss. Let me get out. So if the market eventually goes in your favor, and your mind will be telling you, can you see? You got out, but the market went to your favor. Yes, tell yourself, yes, but I was acting like a fool. That's why I got out. And I don't want to train my brain to be acting without following rules. You're building discipline. So number 4, you're now looking for the candlesticks confirmation, the trigger. Everything is set. You have 3/3 now. You want the trigger. You have time. You have aimed your target. You are waiting for the thing that tells you, oh yeah, enter. And now there are other confirmations that you use. So apart from these 4 rules, 1, 2, 3, 4, there are extra confirmations. And the number 1 extra confirmation is number 1, chart patterns. Okay, sorry, let's finish with the trigger. So now you're looking for the trigger. What are you looking for? You're looking for bullish engulfing. You're looking for hammer. You're looking for tweezer bottom, or you're looking for what? Morning star. So you're not looking at that area. You're looking for the candlesticks that make sense. You see the first hammer. This is a hammer. Forget that the color is red. You understand? Forget that the color is red. This is a hammer. A hammer always has a long beak, a body, then a bullish distance. So yeah, so this is a hammer. So let's say you are not even confident in taking this one. The next one closes above the hammer at an area of support. So this combined, this is a hammer, this is another bullish close, then this is your entry. If you are not confident to enter here, this is your trigger candle. Why? You can as well say this one engulfed this previous candle. So you can enter here. If you are not confident, maybe you draw a small this thing here, you wait for the breakout, you enter on this candle. But the perfect, because now there's a clear breakout here. You enter on this candle that did the breakout. But then this candle is an area of resistance, but you don't mind. Why? The overall trend is up. So if you enter here, you put your stop loss below here. Always give your trade enough room so that when you are wrong, you know that I was really wrong. The market was not just for me. But sometimes if you put your stop loss too close, the market comes and stops you out, then goes in your direction. It can be very annoying, especially when you trade only a few pairs and you just missed out on a beautiful opportunity. So you wait for this. So this is your entry on this candle or on this candle. Now, this candle also formed, okay, this is not a perfect morning star, but this is looking like a morning star. A morning star is when you have these 3 candles. Then this one, if this one had closed above this one here, then you have a perfect morning star. See a morning star here. This is an evening star. You have this, then you have this one that closes below this one. So these 3 candles here, you can call them an evening star. You understand? Then this is your tweezer top. This is a doji. Do you understand? So the more you look for these candles, the more you get to understand them. Okay, so now you now have your trigger. So how many do you have now? You now have 4/4. So with 4/4, what do? You take the trade, put your stop loss below here, target the different zones. Your first zone, take profit here. Your second zone, take profit here. Then if you open 3 positions, then you hold the other position to see if this market will break above. If it doesn't break above and it starts giving you this kind of pattern, you close the other position and wait and see what will happen. Do you understand? Why? Because you're trading from zone to zone and this price is struggling to break that zone. So instead of waiting to see if to break it, if you're struggling, I just get out, take your profit, wait for maybe a pullback and enter or a breakout. Now, this is another opportunity here. Okay, now extra confirmation. Your extra confirmation you only need 4 confirmation, but sometimes you need something that gives you extra confidence in the trade. So you look at for chart patterns and or where price is on the indicator. So by chart patterns, you're looking at double bottom or inverse head and shoulders in an uptrend. So in an uptrend, you're looking for double bottom or inverse head and shoulders. An inverse head and shoulders is also a complex double bottom because this is a double bottom. This is another one. So in this case, we had a double bottom here. So that gave extra confirmation. Do you understand? So that gave more confidence. It's called confluence, looking for confluence. Then the next confirmation is this baseline, this moving average. Price is sitting on this moving average. So the moving average is acting as another dynamic support. So this is extra confidence. So that means you have 2 other confluence, meaning this trade is a high probability trade. Why? Because apart from having 4/4, you now have 2 extra confluences. Do you understand? So that's it for the buy. For the sell, let's see if we can take an example for the sell. For the sell, everything has to be reversed for you to have a perfect sell. All these moving averages need to cross below. So we need to go back to the past and here now. So in this kind of situation, all you're looking for is sells. So you ask yourself, when you see the opportunity, you mark out your lines again. See here now, you draw this out. This is a resistance. So you ask, is price as an area of resistance? Yes. Number 1 is answered. Number 2, is price below your market baseline? And so price is above these other ones, but below a key one, which is the 200. So you say, yes, it's below because it's below the 200. You say, yes, it's below. So you have 2/2. Then the third one is your RSI. See your RSI. Your RSI is oversold or overbought rather. It's overbought. So RSI is overbought. That's 3/3. Then the fourth one, you're looking for a trigger. You're looking for a trigger. This is a good trigger, this one, or even these 2. a good trigger, you enter. Your stop loss comes above here. First take profit here. Second take profit somewhere here. Then the third take profit you might hold. You know, if it's only two take profit you can set, fine. When the market pulls back like this, you enter again, repeat the same process. Take stop loss there. First take profit, maybe somewhere here. Second one like that. So that's how you do it. Then you can now look for confluence again. What chart patterns do you see? Here, there's something like a double top, like an M. You know, the other side, we have a W. That's a confluence. Then it's very close to the moving averages. Sorry, the 200 moving average, that's another confluence. You know, so that's how you do it. So you have 4/4, then you take the trade. And the reason you're following the confirmation checklist is because you know that not all your trades will be winning trades. You know, but whatever the outcome is, you want to be sure that you are confident in the trades you're following. You don't want to start doubting yourself. That's the reason for following a fixed rule. When you follow a fixed rule, it removes the doubt that you might be having in your mind. Oh, is this right? Is this wrong? You want to remove those doubts. You just want to say, okay, I'm here now. So what you do, the next thing is now money management. If you have, let's say, $500 in your futures account, don't enter more than 2 trades at a time. And in each trade, for me, for example, now, since I don't trade many pair, if I'm entering one pair, I risk like 5% and I don't enter any other trade. So if I can go to bed at night, well, knowing that if I lose, it is 5% of the balance that I'm going to lose. Sometimes 4%, sometimes 3%. You know, that's what I'm going to lose, and I'm okay with it. Do you understand? I give good room for my stop loss and I set my different take profit. So that way I'm not over risking. You know why? Because you're playing the game of survival over a long time. If you are consistent, you can make money over time. Then that is this for this. Then for those who say they want to use naked chart, it's the same thing. I use naked chart too. So in using naked chart, now you have to rely a lot on market structure and on your candlesticks, a lot. You know, then you can now also have to do top-down analysis. Like see here now, this candle has closed bearish. If you look at your RSI, you might see divergence. You know, you might see divergence. So if you're trading naked chart, you have to be following this kind of thing. See this divergence. So most likely, this market might pull back a little before shooting up. Before shooting up. Okay, this market might pull back a little before shooting up. Sorry, I had a call. So that's it. So for naked trading, your life is simple. You're just following market structure. You're just following market structure only. When price comes to a key level, you buy. You know, you're following the overall uptrend. So you don't need indicators to do that. You don't even need your RSI. You just need to know the levels. So, and be very familiar with candlesticks patterns. That's why a lot of people like naked chart, because they're only following candlesticks and support and resistance levels. So there's really nothing to teach about naked chart than to master support and resistance and support and resistance and market structure. You know, using your trend lines, your support and resistance zones. That's all you need to do when you're doing naked chart, nothing more. Every other thing as scheduled, you know, just focus on levels. Like this level has been broken, the next level will be tested, price is here, it's going to go here. So that's all you do in naked chart. If you break this level, the next level is up there. I've drawn it out already, you know, so that's all you do in naked chart. You know, nothing more, nothing more. All right, guys, we've come to the end of this. Thank you for joining. Stopping this recording now.